Welcome back, fellow investors. Let's have a look into Clorox earnings today because the stock got hammered this week after their second quarterly earnings release. Hence, in this video I'll show you if they were indeed that bad, why the price was falling, and whether I see this as an opportunity to buy the dip. In the end, I'll also show you my updated valuation for the company. But hey, let's get straight into the numbers and show you some of the information behind the headlines. First of all, let's remind ourselves that Clorox is a true dividend aristocrat. Actually, it's close to becoming a dividend king because it has already 44 years of uninterrupted dividend growth. This means that it only needs an additional 6 years of dividend growth to become a dividend king. From that point of view, it becomes even more attractive because the company is finally having a decent yield again. It now trades at 3.28% yield, which is a perfect starting yield according to my dividend screener. But hey, that's why it should probably come as no surprise that I started to look into the Clorox this weekend. But beyond my dividend screener, I really like consumer staples. These are these kinds of companies that do well in every economic cycle. Of course, you want to be more in growth when there is a bull market and maybe a bit more in defensive stocks when there is a down cycle. Well, consumer staples like Clorox, for instance, should definitely be considered defensive and really provide discussion in your portfolio when there's a downturn. But hey, maybe you don't know Clorox actually, so let me give you a brief introduction about the company. This company earns its money via their health and wealth business, household, lifestyle and international. Now most of you who know Clorox will know it via their cleaning business and they earn 30% of their revenue via this. But other than that, you will see that it's quite diversified because it also sells vitamins, minerals and supplements, but on the other hand also cat litter. But don't worry if you don't know it as a European because it's actually quite common. The company is hardly present in Europe with their products because it's also just a really small portion of their profits. What we are more familiar with are products like Domestos and such, which are produced by Unilever. Hence, if you look at it from an international perspective, Clorox is not such a large company like, for instance, Unilever or Procter Gamble. So I'm not surprised if you don't know their brands, but as Americans, if you're listening, then you should probably be really familiar with these. And of course, the iconic brand Clorox is here, but also Calm, Brita, Fresh Step, and so on. These are all top brands with strong market positions. But okay, I think you get it. Strong consumer staple with strong market penetration. So why then did the company drop on a single day with almost 14.4%? This is just unheard of. So let's have a look into the quarterly earnings statement that they just released Thursday night to see what is really going on with this company. Now I can tell you after reading this, suddenly this 3.28% doesn't look so good anymore to me. Because net sales declined in organic way by 8% year over year. Which from one side shouldn't come as a surprise because of course they come from a really large base because everyone wanted to clean during the pandemic suddenly. But what we also see is that they are not having such strong pricing power because their gross margin decreased from 45% to 33%, mainly driven by inflation. What this tells me is that they are not able to pass on the price inflation to their customers. Who are their customers? Companies like Walmart. This should come as no surprise because we have for instance seen that in the Netherlands, Ahold is in a fight with Nestle. Currently there are some empty shelves in the local Albert Heijns because they are now not able to supply some of the Nestle products. And this gross margin decline has a large impact on their earnings per share because the earnings per share declined with 67% to 66 cents. This is really a large drop when you think about it, even if it comes from a top peak during the pandemic. And the sad thing unfortunately is that they are still expecting cost pressures to continue through fiscal year 2022. What is important to know, these are the second quarter earnings of the Clorox company, so they have still 2 quarters to go. Unfortunately, there are really not so many highlights in this quarterly earnings reports, and the only thing I noticed here is that they grew market share in the majority of its businesses. Yippee! But where the real horror comes in is the health and wellness business, specifically their cleaning products, because net sales declined with 21%, mainly driven by an 18-point decline in volume from lower shipments in cleaning and professional products. However, if you look at it from a bright side, on a 2-year stack basis, net sales grew by 21%. Now, why this large sales decline? Of course, it came from a really high peak compared to a year ago. Other than that, if we look at household, also lifestyle and international, sales were okayish, even some organic growth. Now, okay, we get it. Large declines because of the peak earnings that they had last year. And as I mentioned, this should not come as a surprise. But what is really horrible and why this report is so bad is because also the fiscal year outlook is bad. They are expecting a further net sales decline in the range of 1 to 4%. However, in the fourth quarter, and this should be around May, the company expects to start sales return again into the target range of 3 to 5%. But besides that, the gross margin decline should not come as a surprise. However, they assume to return to a gross margin expansion again in the fourth quarter. So in other words, they believe that this 33% margin that they currently have is the bottom. But what it also means is that we need to take this bottom into consideration when we are modeling our future earnings, when we are doing the valuation of this company. But last but not least, they expect an EPS going forward between $4 and $4.50. So this is it. This from the earnings report, really bad. But also have a quick look into their 10K because you always find some interesting nuggets here. If we look at the segment results, which were really hammered, the health and wellness, we can see here that the 3 months ended really had a strong drop with 21%. But there's still something that might give us as investors a little bit of hope then when it comes to the earnings going forward. Because what they say here also is that the volume and net sales decreases were preliminary driven due to lower shipments in the professional products portfolio as customers continue to work through high inventory levels. Now, this is important to know, so they effectively still need to clean a lot before they need to start buying new products from Clorox again. So what this means to me is that over time, we should return at least a little bit again in gross margin and an uptick in sales. But well, this was it from an earnings report point of view. Now let's look at some of the basics and how I evaluate a company to judge whether Clorox is a company to consider right now for me in my portfolio at an attractive yield of 3.28%. So if we look at the price chart, it was already in a steep decline since the summer of 2020 at the peak of the pandemic. But what I find actually more concerning is that if we look at the bottom that it had in 2019 several times, it broke through it. Now, I'm not a technical analyst, but I do generally know that these are some basic trend lines that we should consider as stock investors. So from a stock price point of view, it might mean that we will see some free fall here, but I leave it to the technical analysts that are watching this video to give me some better information here. Now, if we look then at the EPS and the free cash flow trend that I typically like to look at, you can see that the trailing 12 months have been horrible and they have been far down to the trend. The question is, how much can it pick up from here again? And the company believes that it should be around $4.50 as we just saw. So what it tells me is actually that we are back to 2015 levels when it comes to the earnings. And we need to take this into consideration. If we also look at it from a cash allocation point of view, it's another important metric that I look at as a dividend and value investor. We can also see that the company has been overspending the cash that they were getting in via the free cash flow, because in 2021, for instance, they got $945 million in free cash flow. They paid out $558 million in dividends, but also bought back shares at a value of $905 million. This is a lot, effectively $1.4 billion, while the company was only earning $945 million in free cash flow. Now, the good thing is that they were not doing this by massively loading up on long-term debt, because their 2020 free cash flow numbers were just amazing. And we can see that here as well when we look at the balance sheet. The long-term debt declined in the last 2 years. However, also the cash and cash equivalents declined over the last 2 years and the trailing 12 months. So there's not a lot of wiggle room anymore for this company to do further buybacks when we see that also their free cash flow got hammered in the last year. So my conclusion looking at this is that they were really a slow grower and they had a peak during the pandemic. This is wiped out now. Literally, and it's being impacted by inflation, and we see that back in the numbers. But okay, this doesn't mean necessarily that it's a bad stock to own now. So let's look into some more of the metrics that I've prepared for you. So if we look at the dividend history, it has been nicely growing over the last 10 years. You could even argue that it almost doubled. What should come as no surprise though is that the free cash flow is not anymore covering the dividends. Effectively, 100% of the dividends are being paid out right now. This is not something that I get really happy with. But also let's have a look at the key statistics. What we can see here is that this company has been growing for 44 years the dividends. Current yield, as I mentioned before, 3.28% and a 5-year dividend growth rate of 8.5%. Where it all gets red is really around the valuation. This shows that the company is just heavily overvalued even after the current price dip. Revenue growth is still taking into consideration 2021 numbers, so take this with a grain of salt, please. However, it has a strong credit rating with an A-, which means that it has a really solid balance sheet, and we saw that before already. Debt to equity, however, is on the high end, but this is mainly due to the share repurchases. Also, because of the last trailing 12-month numbers, the return on capital is really weak compared to the cost of capital. I expect this to go up to normal levels again, and then you should see an approximately 10-12% value creation here. So just based on this, based on the latest numbers, the company looks to be strongly overvalued. But it also doesn't necessarily mean that it's overvalued right now, because these are historical metrics, mainly looking back. Let's have a look at how much the company would be worth today if we start to take some assumptions towards the future. Okay, let's look back at what the current free cash flow numbers were, just to take a clue for what we should take as a number going forward, or as a baseline for our calculation. So what we can say is that the trailing 12-month cash flow numbers are 580 million right now, and the free cash flow numbers were around 786 and 780 million in the 2 years pre-leading the pandemic. I think this is a good reference point to look at, but we need to take the higher inflation cost into consideration. Hence, what I suggest is to take 750 million as a baseline right now for consideration for our calculation. Based on what the company was saying, a 3 to 5% revenue growth, I will be modeling in my baseline case with 6% free cash flow growth over the next 5 years and 4% thereafter, also using a discounted rate of 10% and a 14 multiple. In the optimistic case, I will work with an 8% growth over the first 5 years and 5% thereafter, and the bearish case 4% and 2% case, because maybe these inflation costs are there to stay, maybe the pricing power continues to be weak for the company, who knows. In that case, I will give the probability of 60% for the baseline case. Optimistic, I am not really optimistic, I must confess, so 15%, and bearish 25%. In that case, we're talking on average about a fair value of $95. This might come as a shock to some of you, because the company is trading at $140 right now. So in my opinion, this company is still 32% overvalued. This is a lot, and it has really got a lot to do with the fact that it's not anymore earning the money that it was earning during a pandemic, where everyone was scared and people were massively cleaning and maintaining their houses and the buildings and whatever more cleaning products they needed from Clorox. And I can give you another example, because what would this company really need to do to justify the current price? So I also have a calculator here. Let's assume that, for instance, the free cash flow going forward would be on a high basis, 900. Yeah, this is really optimistic. In this case, what you will see, based on a 6% growth first 5 years and 4% growth thereafter, the company would still be worth just $118 per share. So also the growth numbers should be higher. So let's model with 8% and a 6% thereafter, and let's see what the price would do then. In that case, we will be talking about a fair value price of just $134. There you go. Now, what you should ask yourself now is 900 million indeed a good free cash flow baseline basis for you? I would argue not, because in 2019 it was far from making those numbers, and you should also wonder, is a slow-growing company, generally in revenue, or a company like Clorox really growing with double-digit numbers? I believe neither. Hence, my conclusion, even with a yield of 3.28%, is that this company is way too expensive for my liking right now. I might buy something around $100 maybe, just to dip in then. Also knowing and showing my appreciation for the fact that they have been growing the dividends for 44 years already, but so far I will be staying away from this. Having said that, if you like this kind of videos and you want to see more of this, check a video on the left to see my analysis about HP Inc. and check the video on the right to see how I'm analyzing companies based on the fair value assessment. Have a good week, everyone.